Hi guys and welcome back to Yashi. Today we're going to talk about the Federal Reserve meeting that will happen later this month, what to expect, and the different scenarios, the different, let's say, underlying factors happening right now that could affect the decision of the Federal Reserve and Jerome Powell. So let's get started here. Let's hit record. We know that the next meeting will be March 21st and 22nd. What is the current state of the Federal Reserve interest rate, the base interest rate? We're gonna go on federal funds rate right here on bank rate. The federal fund rate today is between 4.5 and 4.75%, the highest we've seen in the past pretty much decade. It is very high. The reason is that the Federal Reserve has been raising interest, making it more difficult to borrow and more expensive to borrow in order to fight inflation and disincentivize consumption. Is it going well? Is it going badly? Well, we definitely seen a good pattern in the past couple of months with inflation coming down. January, we saw inflation ticking back up, but the past report that we saw last week, as you can check in the last update, has been positive again and met the expectations of investors again. And it definitely can bring some positivity in the thoughts of the Federal Reserve. What are the expectations? Before we go into expectations, there are some things that happened. You may have known already, you may have read, pretty much everybody has read about it. We had some banking issues in the past week, starting with SVB and First Trust Bank, First National Bank. SVB started to fail because of a bank run. First National Bank did too. And then also on the European side with Credit Suisse. Credit Suisse was in a different situation. Let's talk about the American banks. What happened? It seems like banks went into a bank run as it happened. This is probably the second biggest bank run according to media outlets. But if you look at the bigger picture, it isn't really. The last bank run was a little bit bigger than SVB Bank. The problem is it was during 2008. If you consider in inflation, the size of the last bank run was much bigger than this one here, because the value of the dollar now is much lower compared to the dollar 15 years ago. The fact is, what happened with SVB Bank? Was the bank in a problematic situation, or was it a consequence of something else? The bank was basically mismanaged. They invested many of the customer deposit into treasuries before interest rates went up. And because of the inverse relation between interest rates and treasuries, which are the bonds, the way that the government can loan money, get money. They have an inverse relationship. So as interest rates went up, the value of those bonds went down, bringing the, let's say, asset value of those assets that SVB Bank was owning to a loss. The moment where people realized that SVB banking was in a tricky situation, everybody ran to the bank, tried to pull money, and SVB Bank had to try to raise money, which it didn't have, and that's how we went through a bank run. What happened? Basically, the government came in, and not only did they protect all the first $250,000 as, let's say, regulated as per now, every depositor is insured for $250,000. They protected the entire deposits of all the depositors. Reason being is SVB Bank is a commercial bank. They work with many companies. If you lose all that money, you're having a whole chain effect across many companies, vendors, and much more. So although it might sound very bad that the rich still won, it kind of protected everybody, because it would have affected also employees who wouldn't get money and much more, and maybe would have had effects across a much bigger net than we thought. So is it good? Is it bad? The fact is companies and the companies were saved, the bank wasn't saved, but the deposits were. So the government came in and saved these people. With the second bank run with First National Bank, Signature Bank, we have to see what will happen on that one, but it seems that they're trying to protect the depositors there too. And then came Credit Suisse. I will not go deeper with Credit Suisse because it is another state. Yes, it can be related a little bit to all this, but the situation is a little different. The fact is, these are smaller banks. The customer base of these banks were mostly commercial or crypto related when it came to First Signature Bank, which is not, let's say, as important. It is still important, but it's not as important to the American depositor. For example, with banks like Bank of America, TD Bank, and many others. Fact is, government saved these banks, but we still saw that these high interest rates definitely damaged the assets of many banks. Even the bigger banks have been damaged by this. The government came in with this saying that in the case of a liquidity crunch, banks can get a loan from the government for the par value of the treasuries, only treasuries, so that they can give the money back to the investors. What does par value mean? Let's say that the bank needs a lot of money. They can go to the government and say, hey, I own $1 trillion of bonds, but right now the current values, they're worth 500 billion. If I wait for the end date of the bonds, I will get the whole money back. Can you please loan me the money for the amount I paid for those bonds? Basically, the way bonds work, at the end of the day, you get back the money that you invested into it, most of it. So such a program actually makes sense. I will not go too deep into it, but you can look into how bonds work and the par value of bonds. With that said, what does this mean? Will this affect the Fed's decision? Yes or no? We know that the government placed in protective, let's say, measures for liquidity, but we also know that the Fed is starting to damage banks and it's starting to have more and more effect. If you look at the bank's balance sheets, it's not looking very good. On the other hand, we still have high inflation, but that has been slowing down. I will give you now my quick opinion and I will also give you the market expectations. I believe that most of the interest rate work to abate inflation has been done. The rest of inflation, I believe, is a consequence of supply chain issues, kind of like what is happening now in Ukraine, the food crisis, water issues, supply chain. There's not enough workers to do all the jobs that could improve the supply chain. So I believe that most of the inflation will come with innovation, technology, and people coming back to the workforce rather than the Federal Reserve increasing the interest rates. But this is just my opinion. Please do your research and please formulate yours. With that said, let's go on to the market expectations. What the market expects on the March 22 meeting is either 25 base points, so 0.25 increase in the federal funds rate from 4.5, 475 to 475 and 5, or no movement at all. Another thing they're predicting is that the next meeting, we are very likely to stay around the 5% mark, or the 4.5, 4.75 mark, but not go above 5%. This is what the market is expecting, which is different compared to a week ago, before the whole bank runs and everything, because we're starting to see bad signs from the market and from the banks. This is what the market is expecting. What do I believe in this? I can tell you this, inflation is going down, not as quickly, but it's going down. I believe that most of the remaining part of inflation is due to supply chains or simply supply and demand. As people get crunched money-wise, they will spend less and it will affect businesses who will be forced to drop prices. This is my opinion. Again, not financial advice. Number two, banks are hurting. If the Federal Reserve keeps on going up and people need to pull out money, this could affect also bigger banks as the value of their assets will decrease even more. They can tap into the new regulation of the government and get loans for their bond values, but the less we play with this new regulation, the better. The Federal Reserve is between a hard spot and a rock and a hard spot, I don't know how you say in America. I believe that on one side, the Federal Reserve want to still signal that they're fighting inflation. On the other, they don't want to hurt the economy too much. So giving a signal without destroying everything or giving too bad of a signal, I believe that a 0.25% increase could make sense. Even if a 0% increase could also make sense, I believe that still signaling that they're trying to fight inflation without being too, let's say, aggressive on that could be a good mix of the two situations. It could give a good signal and it would still meet market expectation, as the market is expecting still an increase nevertheless, which could make sense. Again, this is my opinion, not financial advice. I just wanted to give you a bigger picture of what is happening. Let me know what you think. Let me know if interest rates are affecting you, if it's making you wait to buy potentially a new house or something. I post a lot of housing updates here and there if you want to check those out too. Thank you for watching. If you like what I'm doing, please like and subscribe. Ciao.